Good morning, everyone. We have just hit 11 a.m., so we are going to get started with today's investor briefing while a few more people are logging in. My name is Alfred, and I'm part of the investor relations team at Novatti, and I'll assist with running today's quarterly investor call. We're joined today by Novatti CEO Mark Healy, who will provide a detailed update on Novatti's activities and progress on the business transformation that started 12 months ago, for which investors are now starting to see the financial milestones being achieved. With each quarter, Novatti has progressed through each stage of transformation, so Mark will be able to discuss in more detail as well as answer any questions you might have. If you do have any questions, you can submit them via the bottom of your screen where there's a Q&A box marked with a little speech bubble. Just type them in, and once we get through the brief presentation, we'll read them out to Mark and we'll get a response directly from him. It is obviously a very busy day on the ASX with plenty happening around June quarterly, so I won't take up any more of Mark's time. Mark, let me hand over to you.
Good morning, Alfred. Good morning, everybody, and thank you for joining the Q4 update today. It's a very exciting time at Novatti. We are working through a period of major change and opportunity. For those that are following us closely, we're now deep into a significant transformation and turnaround under the new management team, which is very structured, it's well underway, as Alfred mentioned, and in Q4 showing some particularly strong results, which I'm very pleased to talk to today. However, for those new to us, perhaps just a quick recap. So Novatti is a B2B payment solutions business. In short, we enable businesses to pay and to be paid. That is, to both receive and to make payments. This is a really simple but really important statement of position and difference to other payments businesses. Our industry has many payment service providers, but they are largely monoline and offer one or perhaps two products, whereas at Novatti we've built a full payment stack built around an ecosystem of licenses, partnerships and technology. To my knowledge, there is not a comparable payments company with the matching breadth of capabilities in Australia. As I inferred, payments is a very crowded and noisy marketplace. The language, the technology and the choices can be very confusing for business owners. Our value proposition is the simplicity and the completeness of an end-to-end offering through a single relationship. We offer a full range of payments processing and acquiring services across all business sales channels, online, in-store and mobile. We offer a range of alternative payments from vouchers and top-ups, which is where the business started, to real-time pay by bank using the NPP platform and future payment methods such as our stablecoin. Many businesses now have some form of cross-border trade, either importing or selling overseas, and we offer global currency accounts and FX services, along with payments direct from a range of Asian wallets such as Alipay. We're also an issuing principal member of Visa and offer a range of digital, physical and virtual cards across many different use cases, both directly to businesses and also to other fintechs. Our challenge and opportunity is to bring this ecosystem of process, product and platform capability into a seamless experience aligned tightly with our target markets. The company that I took over nearly 12 months ago now was effectively 12 independent businesses without any effective strategic cohesion or synergies. The strategy was reset in mid-2023 when I took the role to leverage our strengths to reorganize and reduce down into a payments solutions business with a specific focus on the ANZ market. The strategy itself has three simple and overlapping elements. First is to simplify and streamline the company around payments, Australia and New Zealand, and over time to remove the distraction of everything else. Second is the shift from a sales-led product-focused mindset and a mode of operating into a market-led customer-focused business. Previously, each part of Novatti and each business unit went to market directly without overlapping direction and without a cross-selling culture or an integrated approach. Thirdly, a pivot away from a singular focus on growth and revenue growth to a profitability focus and to reposition the company's governance and operations towards operating profitability as a primary goal. The business is now very focused on payments at our core. We are positioning in market around the value proposition of end-to-end payment solutions, and the whole business is focused on lifting margins and operational efficiency to support the drive to positive operating cash flow. This is a busy slide, but it's worthwhile understanding just the range and depth of the work underway on the strategy. There is a very extensive set of initiatives, some completed and many still underway to execute around the strategy. In terms of simplification, payments are now at our core, and there, as I mentioned, there is a specific focus on ANZ market penetration. We're currently consolidating a range of critical processes that interface to customers, particularly around sales and customer onboarding. We've restructured and reorganized around a new functional structure and operating model to support the sale of integrated solutions. And we continue to undertake a strategic review of all areas in the portfolio. And the results of that can be seen through the sale of the Reckon stake, which was used to pay off the corporate bond, and the recently announced sale of our interest in RBOA, both as non-core assets. The second element is the switch from a sales-led product-focused mindset and operating model to a market-led customer focus. We have established a marketing function and a strategy and now have a clear line of sight on our target verticals and our specific customer types. We've integrated the multiple payment sales team into a single payment sales team for Payments Australia and New Zealand. We've also established a product management function for the first time and streamlined access to different products across the ecosystem of our capability. We've initiated a brand refresh to reposition our messaging around our core value proposition and our key strengths. In terms of our financial performance, this is both an input and an output. The new management team operates very differently to the previous management team with different systems, mindset and culture. We are making planned and considered changes to the business to realise value for shareholders and not to disrupt our core growth drivers. There has been a very significant H2 of FY24 focus on reducing costs, resulting in a $1.8 million net operating cash outflow reduction in Q4 versus Q3. And that's been driven by two phases of our cost reduction program. Phase one was implemented in Q3 to drive a $4 million annualised OPEX reduction. And the second was implemented in Q4 to drive a further $3 million annualised OPEX reduction, which will be seen in the Q1 FY25 results. We've also made and continue to make changes in process, reporting, goals, and sales incentives to continuously work on lifting margin in our core growth engine of Payments ANZ, with a 3-year target of 70% gross margin previously set and looming on our horizon. Okay, in terms of Q4 more specifically, we can see the progressive outcomes of all the work and those initiatives on our turnaround strategy. We've now fully implemented the $4 million annualised cost reduction program deployed in Q3. And our cost reduction to date has contributed to a 41% drop in net operating cash usage versus Q3, as I just mentioned. Group revenue grew slightly again to $12.5 million, which is a 23% uplift compared to the prior comparable period of Q4 in FY23. Our Q4 OPEX, excluding the bank OPEX, reduced by 29% versus the prior comparable period, again, Q4 of FY23. And you can see very clearly here in the graphs on the right-hand side, the operating leverage now being improved inside the business. We acknowledge that we're not done yet and accept there's more to do. However, the new team has delivered 4 quarters of consistent execution of concurrent revenue growth and cost reduction and demonstrated solid progress towards our goal of becoming cash flow positive, operating cash flow positive by the year end. More broadly, stepping back and looking across the full year of FY24, we've seen a 19% increase in revenue versus FY23, lifting to $46.5 million. We've reversed the prior very tight coupling of revenue to OPEX. You can see it's almost 1-to-1 here in FY22 and FY23. There's been a 21% reduction in OPEX from the prior year. And again, most importantly, breaking that tight alignment of revenue growth and OPEX growth, opening up that operating leverage, which we expect to continue through H1 of FY25. And with the significant restructuring and expense control in the business during H2 of FY24, the Q4 operating cash usage has dropped 38% again on the prior comparable period of Q4 of FY23. Looking ahead into Q1 of FY25 and that pathway to operating cash flow positive has essentially two primary drivers. Apologies there, I think I just switched slide to trigger happy on the mouse. The first is ongoing actions on the cost base. We will see the impact of the phase 2 cost reduction program of a further $3 million annualized reduction in expenses through Q1 of FY25. That additional program is driven by a combination of actions, some of the key ones being contraction in our cross-border services. This is a conscious decision to retain a focus on our B2B customers, but step away from providing wholesale services to third-party money services businesses, which have a high cost to serve and low profitability. There's been a reduction in the size of our offshore technology team and a reduction in our office footprint, both onshore and offshore. I'll also mention and state again, there are additional activities underway flowing from the ongoing strategic review, and we expect to make further optimization and divestment decisions of various business activities as we flow through H1 of FY25. The second element here is to continue to drive actions to lift our margin. Our commercial strategy is now targeting mid-sized businesses and ISV and software partners specifically. Both of these customer types require a high-trust operating partnership, shared commercial success, and tailored payment solutions. All of that can be handled via a single relationship through and with Novatti, and this is a very powerful offering in the market. In our customer backbook, we're also working more actively now to ensure appropriate margins through more regular review and benchmarking against performance and the customer risk profile, a process which has already seen some offboarding of customers through the second half of FY24. A little more detail on the underpinning marketing strategy in support of that. Our initial target verticals can be seen here, and we launched into the education vertical in Q4. In Q1 of 25, we commenced a property tech market entry campaign. These selected verticals build on some pre-existing brand awareness and several key clients we have in the education sector particularly. But more broadly, each of these verticals that we're targeting are large, they're growing, and they're complex markets where we have the ability to cross-sell products and services over time to our customer base. At present, I'll call out, we're finding that the acceptance and processing of Asian wallet payments is a real advantage for us and a wedge solution, both assisting our market entry and customer acquisition, particularly in that merchant acceptance arena. Across FY24, we've seen a 15% lift in our merchant acceptance customer numbers, and we expect this to further improve across FY25. And the early results off the back of our recent go-to-market campaigns in education and PropTech have already built a confirmed pipeline of 500 merchants that are currently onboarding over the next 6 months. Stepping back a little just around the macro opportunity, the business is very well positioned to benefit from the future structural and behavioural changes that will play out in the Australian market in digital payments. I think we'd all accept that software is now creeping into every aspect of our lives. We're moving into a world where all SMB payments will be sold and embedded via integrated solutions. B2B particularly has a lot of complex logic around the AR and AP workflows inside mid-sized businesses that require tailored solutions for any mid-sized business. Most SME businesses in Australia and New Zealand are still very early in their own digital transformation and enabling digital payments technology. This has been proven out from some research last year that showed nearly 50% accept the need to improve their payment systems, and 80% of medium and large businesses believe that payments are a critical enabler of their own digital transformation. Well, what does that mean? It just means that we are now facing into a market that's ready for change and adoption, and that's a big tailwind for Novatti. We can help our customers transform using a single relationship and platform. We enable our customers to operate their businesses more efficiently with our multi-sided solutions and support for all facets and types of digital payments. So how are we positioned in and around this opportunity? Well, we're now organised around 4 pillars. 2 pillars in payments, the core engine being Payments Australia and New Zealand, and then Payments International. A third pillar centred around our software solutions, and the fourth around our investments. historically at IBOA and now AUDD, which is our stablecoin. The core focus and the future business strategy is centered around that first pillar of Payments Australia and New Zealand. This is the absolute bedrock of the strategy. It's where we're making product investment and building out and integrating a full digital payment stack. The three domains to the right of Payments Australia and New Zealand all remain under strategic review, with optimisation and divestment activity underway to streamline the portfolio. Some key themes just to call out here quickly. The Payments ANZ business is still very young. It's effectively only 2 years old, but is our core and already contributing the largest in gross margin. This is the area of accelerating performance and our future growth vector. The growth here is ahead of any other part of the business, and this will only enhance over time as we focus our marketing, our product roadmap, and our customer aggregation in this area. Our international payments division comprises what we call alternate payments, which is our EU-focused payment vouchers, and ATX, which is our Malaysian bill payment and top-up service. This is the largest contribution by revenue, but the lowest by gross margin. Gross margin growth here is slightly negative. However, this pillar is consistently delivering a positive bottom line, given its maturity. Tech Solutions is a suite of software businesses, mainly centered around billing solutions and our legacy tech implementations that we are not investing further in. Basically, they're in maintenance mode, but we have a very sticky client base here, again, with contribution to a positive bottom line. The mandate around our investments pillar, or businesses that we've incubated, is they must be self-funding or provide a suitable economic return. I was mentioning the bank, and so like all business units at Novatti, our interest in the bank was subject to the ongoing strategic review, and we determined earlier in the year that it would no longer align to Novatti's long-term financial targets. Following that conclusion, we undertook a substantial process to identify options to create value from our interest, and ultimately landed on the recently announced sale, which completed yesterday for 2.87 million Australian dollars. AUDD, or our stablecoin, has recently completed a seed round for $306,000 and is expected to be cash flow neutral moving forward. And at this point, we retain a 73% shareholding post the recent raise. We believe the new strategy, the initiatives underway, and the continued turnaround will begin to unlock value from within the group, and there's ample opportunity for this value to be recognised in the future share price. Okay, to summarise now and conclude, to repeat again, we're now deep into Novatti's transformation. We are working on and demonstrating clear improvements quarter on quarter to simplify, streamline, and lift our financial performance. Our Q4 results highlight the cumulative impact of the turnaround measures we put in place across FY24. Novatti today is a vastly different business to the business that existed at the end of the last financial year. We are making good progress. At top of the list, we can demonstrate that our quarterly operating cash consumption was down 41% on the prior quarter. While we get our cash use down, we are still proving we can continue to grow the business. We had $12.5 million in quarterly revenue in Q4, a new record again, and slightly ahead of Q3. We will continue to focus on the core elements of portfolio optimization, growth in margin, improving efficiencies, and reducing our expenses. And as an example, we have a further $3 million in annualized cost already earmarked for removal in Q1 of FY25. And further from Q1, we'll see IBOA costs also removed from the group's business and consolidation. But we are not done. More work needs to take place, and we remain committed to positive operating cash flow by the end of H1 FY25. And with that, I'll hand over to you, Alfred, again, and we can take some questions.
Thank you, Mark, for the detailed presentation. We have had quite a few come in already, so we might try and get through as many as quickly as we can. If anyone does have any more, please type them in and we'll get a live response. Otherwise, we'll come back to you by email. Mark, first question is from Ian. Following the change in control of the bank, will Novatti remain a supplier of payment services, or do you anticipate a change in strategy at the bank?
Well, the bank is now under new ownership, and so the go-forward strategy of the bank will remain subject to what the new owners decide and the direction they decide to take. However, we would expect that just given the close historical relationship and the complete breadth of payments capability that Novatti can bring, that would be some opportunity here for us to engage in the dialogue and potentially work with the bank on a close basis going forward around delivery of payment services. So that would be our goal.
Question from Anthony. Can you talk more about AUDD's July raise and also the major increase in payment volume through AUDD, $25 million in 2 weeks?
Sure. So AUDD, as I said, sits inside our investments pillar. It's our expectation over time that there will be in part or in whole a reduction in our stake in that business based around the opportunities available to the business and the opportunities to liberate economic value out of the AUDD business. The AUDD business is, as you mentioned and called out, starting to gather pace and momentum. It's a blockchain agnostic business. There are limited options for an Australian dollar 1-for-1 fiat-backed stablecoin in the market here. And so I think that's starting to resonate as the demand for digital currencies and using digital assets to pay and be paid becomes much more prevalent. And so the use of AUDD in terms of its integration across now 4 or 5 different blockchains is starting to see the payments volume grow over time. I can't speak to the last couple of weeks, though, in terms of the particular volume. If you have a particular question around that, just drop it into the investor relations email box.
Mark, combining question here. Can you explain the reduction in wholesale cross-border service? What does this mean? And does this have anything to do with the Novatti clients removed due to risk profile?
That's a great question. So no, in terms of the risk profile reduction, I wasn't specifically referring to that. That's a separate area that's more kind of broad and macro. That's probably taken the risk profile and negative some clients is more specifically focused on our merchant acceptance business. But getting back to the cross-border side, so historically we've had 2 customer types in our cross-border line of business. One through a wholesale offering, money service businesses or third-party businesses that provide remittance services to end customers. And then our own service, the second line of business has been our own service, direct to business, where we provide effectively a global currency account and the ability to make international payments in foreign currencies for mid-sized businesses. It's the former that we have pulled back on in terms of that wholesale offering to money services businesses. It's an incredibly price competitive market. It's dominated by some very large global players. It's very hard to drive margin into that line of business that has a high cost to acquire, high cost to serve, and high compliance costs. So based around the results of our strategic review, it just didn't fit into a mid to long-term delivery around our financial targets. And so we've made the decision to pull back from that customer type and that line of business.
Thanks, Mark. Question from John. Product manufacturing operating costs account for 85% of revenue. Is there any capacity to reduce cost of goods sold?
Yes, so there's always capacity to reduce our cost of goods sold. As I said, our key driver around the business, or one of the key drivers around the business and getting to positive operating cash flow is to drive gross margin. Gross margin and the components of our cost of goods sold is quite different by nature of the various lines of business. As the core focus around our business and that gross margin is in payments Australia and New Zealand in terms of volume or payments volume and our market penetration and customer acquisition. So that's where our focus will be. As we grow in scale, our supply costs should reduce over time. And also the other flip side of that is just getting better at our pricing strategies inside the market itself. And as our product roadmap matures, we don't have to rely on price as the prime lever of customer acquisition.
Thanks, Mark. Another one from John. The quarterly 4C report does not break out board member or senior management costs. It appears to be wrapped up in the admin and corporate costs. What cost savings were achieved and planned for future operational periods?
Yeah, again, another good question. So sort of on a macro level, our people costs historically represented circa 60% of our operational expenses and a further 15% on contractors, both on and offshore. And so a big part of our phase 1 and phase 2 cost out programs have had to necessarily focus on people. And there's been significant sort of double-digit reductions in people through both of those percentage reductions in our headcount as part of that process. So we topped out, I think, at circa 170 in the later part of headcount of later part of 2023, and we're now down to 122 as at the end of June. And so those, we've been able to make those reductions in a planned and considered way off the back of our restructuring, reorganisation, and that kind of fusion of our operating model and go-to-market into more of a functional structure.
Mark, Anthony's asking, can you provide any more information around the PropTech connection? I think that's the first time we've included them.
Yeah, it's an interesting name, isn't it, PropTech? So it's the actual, the PropTech Association, that industry, the technology underpinnings of the software platforms that drive a variety of services into the real estate sector. So I think I called it out as PropTech and real estate. And so, what we're focused on in terms of our customer type, as I mentioned in the presentation, is both mid-sized customers directly into businesses and also ISVs, or what's called independent software vendors or management platforms or technology platforms that service businesses in that market. And that's what PropTech call themselves in the real estate sector.
Thanks. Just to follow up from that one, just in regards to rent.com, since Novati's been working with RentPay and LifePay growth projections, have we got anything there? And are there any more patents pending around those services?
I'll pick up the second one. There's no pending patents around those services that we are considering in the business at the moment. In terms of our engagement in and around those two, or the particular RentPay client that you mentioned. So we're working very closely with them. We've recently in Q4 launched the China payment services for Asian wallet payments. And notwithstanding the drop in the migration numbers coming into Australia for students, particularly, we're starting to see some really good growth come out of that, and we expect that to continue through the course of FY25.
Thanks, Mark. We are starting to run tight on time, so I'll probably only go through about 3 more questions. Question from Harold: are payment services in New Zealand going to be retained or expanded? Anything new you can share on this front?
So New Zealand is actually a very interesting market for us, and particularly on in the payments ANZ business in and around issuing. We've had some great success through the course of FY24 with 3 or 4 signature customers there in the fintech space, where we put both physical and digital cards into market in New Zealand. And we have an expectation through the course of FY24 through a number of partnerships that are yet to be announced in the integrated software vendor space and integrated payment space to be able to grow our customer numbers in the merchant acceptance space in New Zealand. So despite it being a relatively small market in comparison to Australia, it's outsized in terms of its performance in payments ANZ, and we expect that to continue through FY25.
Great. One more from John. Net cash operating activities is still negative. Cash flow positive by year end requires notional $5 million saving in H2 and or significant improvement in revenue. Can you provide more color to the plans to achieve the positive cash flow going forward?
Yeah, so we accept that we've made some great progress thus far, but we also accept that there's more to do. As I mentioned before, the primary levers around getting to that target and achieving that target are twofold. One is around the continued focus around cost reduction. We've had 2 phases now of significant cost out of the business in a very planned and considered way, and we'll continue to make decisions around cost and take the decisions necessary to get that cost profile to align the revenue to achieve that target. And then secondly, around margin. And so we've talked before and made several releases in terms of our success in terms of merchant acquisition and some recent commercial wins that are driving improvements in margin inside the business. And we'll be monitoring those very closely on both sides of the equation to work towards that target by our target date.
Thanks, Mark. Question from Patrick. You mentioned cash saving from the IBO exit, which was already self-funded. Can you explain this in more detail?
Yeah, so it was aggregated up into our consolidated accounts as a result of being the majority owner. Through the course of FY24, the bank had just over $3.3 million in total operational expense, and in Q4 was just under $800K. So that expense will drop out of the business on consolidation post our exit and sale of the bank going forward.
Fantastic. And just one last question from Andrew before we wrap it up. Will any future cost cuts impact the growth of Novatti?
So we've been making those cost reductions, as I said before, in a very planned and considered way, and they've been coming off the back of the reorganisation, the restructuring of the payments ANZ business here, particularly as we integrate our payment solutions, our people, our process and our technologies in order to go to market in a much more efficient way, in a much more targeted way. I think we've demonstrated over the last 6 months that we can do that without impacting revenue. And so recent history would indicate that we've been doing that and able to demonstrate that we've been able to reduce costs while still continuing to grow the business and execute around our strategy.
Excellent. Thank you, Mark. Okay, we are now out of time. So if anyone does have any more questions, please feel free to email them in through the investor relations inbox and we'll get a response from Mark. A recording of this webcast will be made available on the Novatti website in the coming days. But look, on behalf of Novatti shareholders, Mark, and those in attendance, I'd like to thank you for your time and we look forward to hearing from you again soon.
Thanks, Alfred. Thank you, everyone.